This presentation covers partnerships. It's part 3. And what happens when you add a new partner? Again, in this example, the cash was given directly to the partners. Admission of a new partner. Now, an individual partner's ownership rights include the right of co-ownership in the business property, the right to share in profits and losses as specified in the partnership agreement, and these two rights can be sold unless restricted by the articles of partnership. However, the right to participate in the management of the business, this right cannot be sold without the other partner's approval, so it requires their acceptance. How do you record the purchase of partnership interest when the cash is paid directly to the partners? Admission of a new partner. When cash goes directly to the partners, there are two methods can be used. One, the book value method, and the other is the Goodwill or revaluation method. So now let's take a look at an example. Okay, Pam, Mike, and Dan have a partnership. This is their profit sharing, and their total capital balance is $140,000 at the time of the individual wanting to buy in. And Bill is willing to pay $60,000 directly to the other partners for a 20% interest in the partnership. Bill's capital balance will be adjusted to total capital after Bill is admitted, which doesn't change. It's still $140,000 because the cash is being given directly to the partners. Times 20% equals $28,000. The offset will be a reduction in the existing partners' capital balances times the 20% share. So what we would do is reduce each partner's capital balance by 20% and transfer to Bill. So again, each partner is going to give up 20%, and there's no revaluation of assets or liabilities. So this is what the journal entry would look like. And then after we do this, as you can see, we are debiting their account because normally the balances have a credit balance. At the end, when we look at the P account or the account balances, we now see that Bill now owns 20% of the total capital of $140,000. Now, what happens instead if we use the Goodwill method? Same thing. A Bill is paying $60,000 directly to the other partners for a 20% partnership. So, the first thing we have to do is determine the implied value of a partnership. So, the cash paid divided by the ownership given, which would be $60,000 divided by 20%, the implied value of the partnership is $300,000. Now we need to determine the book value, which current book value is inferred from the combined capital balances of the existing partners, which is $140,000. Again, this doesn't change because the cash went directly to the partners, not to the partnership. Then we're going to determine the goodwill by subtracting these two, which is the implied value minus the book value, which tells us we have goodwill of $160,000. So now what we're going to do is allocate goodwill to the existing partners. We're going to take each partner's percentage of profit sharing times the goodwill, and we're going to allocate the $160,000 based on 40, 25, 35. And this is going to increase the balance in their capital accounts. So if we were to look at the P accounts, we now have increased everybody's balances to reflect the goodwill, and now we're going to take 20% of the $300,000, which is the existing balance plus the goodwill, and what we're going to do is we're going to allocate that now to Bill. So we have to take 20% out of each of the existing partners' account and assign it to Bill. And this is the journal entry. So again, we have to first journalize the allocation of the goodwill before we can do our final entry, which is to book Bill's capital account. Now we go back and we look at the capital accounts after the revaluation and the adjustment so that Bill's account reflects 20% of the total of $300,000. And again, what we would do is, if to check, we add up the capital accounts and they equal 300,000. This ends this presentation on what happens when you add a partner and the cash goes directly to the partners.